So there's three things that you need to start fundraising. Number one, it's the market. It's visibility into the market you're going after. Number two, it's the team, right? Who are you? Who are the people that are on your team? And number three, it's your product, right? So those three factors, what you have is something simple called an investor deck. You create a PowerPoint presentation and it lays out those three aspects into detail, and that attracts the investor. So they say, number one, okay, that's a multi-billion-dollar market at a whole, but your TAM, target addressable market, might be 2 billion, right? And then you can even go even further and say, well, we can capture X percent of that market, and this is a $500 million business right off the top. Then you'll say, okay, our team is made up of a doctor, a ex-CEO of this company, I have this experience. And then you also got to be true, and you got to be yourself, and they will believe in you if you believe in your business. And then your product. So what is your product? What is called is an MVP, minimum viable product. So if you need to develop that MVP or you have it already, that product is gonna cause a disruption in the market. And how is it gonna do that, and why is it different than the other products that are out there? And that ultimately gives the investor the confidence they need to put money in. And then you use those three things to formulate a valuation. Let's say it's $10 million. You want to raise $1 million. You just give up 10% of your company. And over time, you could say, hey, this is all we need to break even. We only need $1 million. Most of the time it's, hey, let's raise 2 million. Let's give up 20%. That's perfectly fine. And then as you're building, your valuation goes up. So let's say the next round you raise at $50 million valuation. If it's $5 million you want to raise, it's giving up another 10%. And that dilution happens over multiple rounds. And then ultimately the goal is to sell or have some type of exit.